There is a used car dealer somewhere in this country that gets the same phone call every single day. Someone calls in, asks what the cheapest car on the lot is, and then asks if they can put $500 down in cash and finance the rest on a $2,500 car. Not a $50,000 truck, not on a lease or something they can't afford. $2,500, and they can't cover it in cash. That detail tells you more about where the American consumer actually is right now than anything the Federal Reserve has said in the last 6 months. And it connects directly to something that just happened to the largest used car retailer in the country. CarMax just reported earnings bad enough to send their stock to a 5-year low in a single trading session. And what they said on that call about why and what it means for everyone below them in the market is worth actually understanding, because the $2,500 phone call and the CarMax collapse are the same story. Let's get into it. Okay, so first let's actually go through what CarMax reported, because the numbers tell a pretty clear story on their own. CarMax is the largest used car retailer in the United States. They have hundreds of locations, they move enormous volume, and they spend a lot of money on analysts whose entire job is to figure out where the consumer is going and what the car market is doing. So when their numbers missed badly enough to send the stock to a 5-year low, it's worth understanding exactly why. The core problem they reported is straightforward. Their prices were too high and their volume dropped anyway, which is a bad combination. Normally, when a retailer is moving too slowly, you lower prices. Demand picks up, volume recovers. That's how retail is supposed to work. But CarMax lowered prices and their sales volume kept falling. Profit per unit dropped to around $2,100, down about 10%, and the number of vehicles sold declined alongside it. What that tells you is that the issue isn't price relative to competitors. The issue is that a significant portion of buyers who would normally be in the market for a used vehicle at CarMax's price point simply aren't buying right now. They either can't qualify for financing, or they can't make the monthly payment work, or they're holding on to whatever they have because the alternative is worse. CarMax even said it directly on the call. They're losing market share because their prices are too high. But when you lower prices and volume still falls, the price isn't actually the problem. The buyer is the problem. Meaning there aren't enough buyers with the financial capacity to absorb what even a discounted CarMax vehicle costs right now. And to understand why that's happening, you have to look at what's going on at the other end of the used car market. Because the data point I mentioned at the top about people trying to finance a $2,500 cash car is not an edge case. Small used car dealers around the country are reporting this as a daily occurrence right now. These are dealers selling vehicles in the $2,000 to $5,000 range. Cars that run, get you to work, nothing fancy. The floor of the used car market. And what they're describing is a customer base that has been pushed all the way down to the floor by a combination of things. They lost a car to repossession, which tanked their credit, which means they can't get back into a traditional auto loan. So they're showing up with whatever cash they can put together, which in a lot of cases is $200 or $300, trying to get into something that gets them to work while they rebuild. And even that population is stretched right now. The phone calls are people asking about $500 down payments on $2,500 cars. People asking what the cheapest thing on the lot is. People who 2 or 3 years ago would have been in a Carvana or a CarMax buying something in the $10,000 to $15,000 range, and who are now operating at the absolute bottom of the market because the sequence of events in the auto lending market pushed them there. Now think about what that means for CarMax. That customer doesn't walk into a CarMax. They can't. CarMax's average vehicle price is somewhere in the mid to high 20s. That's a completely different universe from where that buyer is operating. So CarMax isn't just losing market share to competitors with better prices. They're losing customers to a category of the market they don't even participate in, because those customers got financially disqualified from CarMax's world entirely. So where did those customers go? And more importantly, how did so many people end up in this position at the same time? The repossession numbers are part of the answer. Repos are currently at their highest level since 2008, and every repossession represents someone who is now out of the traditional auto loan market, at least temporarily. Their credit took a serious hit. Their financing options are either very limited or very expensive, and they still need a car. So they filter down to the cash market, to the small independent lots, to whatever they can piece together. But here's where the cycle gets interesting. The repo itself is often the result of a loan structure that was genuinely unsustainable from the beginning. Not because the buyer was reckless, but because the combination of a $50,000 average new car price, 7 and 8% interest rates, and 84-month loan terms created monthly payments that a large portion of the market could not sustain past the first financial disruption they encountered. A job change, a medical bill, a rent increase. Whatever it was, the margin was thin enough that when something hit, the car payment was what gave. And here's the thing about an 84-month loan that people don't fully appreciate until they're in one. A new car loses about 20% of its value the moment it leaves the lot. By year 3, it's typically down 40%. So for the first several years of a 7-year loan, the borrower owes substantially more than the vehicle is worth. If anything disrupts their ability to pay during that window, they can't sell the car to cover the loan. They can't refinance easily because the collateral is worth less than the debt. They're stuck. And when staying stuck becomes more painful than the consequences of defaulting, they stop paying. That's the sequence that's producing the repossession volume we're seeing right now. And every one of those repos puts another buyer into the cash market at the bottom, which is why small used car dealers are getting calls about $500 down payments on $2,500 cars every single day. Now let's talk about Carvana, because this is where things get genuinely interesting. While CarMax's stock is sitting at a 5-year low, Carvana's has been doing the opposite. And on the surface, that seems like a simple story about one company having a better model than the other. Carvana is digital. CarMax is physical. Carvana is convenient. CarMax makes you come to the store. Simple disruption story, right? But when you look at how these two businesses actually make their money, the picture is a lot more complicated than that. CarMax's model is fundamentally about buying and selling cars. They buy used vehicles, they recondition them, they put them on lots or online, and they sell them at a margin. They also make money on financing and add-on products on the back end, but the core of the business is the vehicle spread. Buy low, sell higher, repeat. Carvana's model looks similar on the surface, but the way they generate profit is actually much more weighted toward the loans than the cars. Carvana writes auto loans, bundles those loans together, and sells those loan packages to investors. The car is almost incidental. What they're really selling is the loan attached to the car, and the profit comes from selling that loan package at a premium to the face value of the loans. Now here's where it gets complicated. There's a company called Bridgecrest, which is the servicer for a large portion of Carvana's loan portfolio. And Bridgecrest is connected to DriveTime, which is another used car retailer. And the Garcia family, which founded DriveTime, also has a significant ownership stake in Carvana. So you have a situation where Carvana writes loans, sells those loan packages to an entity that is connected to the same ownership group, books the profit from those loan sales, and the stock price reflects those profits. The cars are moving, the loans are being written, the packages are being sold, the profits are being reported, and the stock goes up. Whether those loans actually perform over their full term is a question that gets answered later by whoever is holding the paper when borrowers start missing payments. And given everything we just talked about regarding where the consumer actually is right now, that's a question worth sitting with. And this connects back to something that happened with CarMax that's easy to overlook in the earnings coverage. They paused their share buyback program. For a company like CarMax, a share buyback is a signal to investors. It says we believe our stock is undervalued, we have enough cash to deploy on repurchasing it, and we think this is a good use of capital. When a company pauses buybacks, it's saying the opposite of all that. Either we don't think the stock is going up, so it's not a good investment right now, or we think we're going to need that cash on the other side of something. Given that CarMax has done a significant amount of subprime lending, and given that their customer base overlaps substantially with the population currently experiencing the highest delinquency rates since 1990, the second interpretation seems more likely. They're holding cash because they're looking at their loan portfolio and their inventory situation, and they're not sure how the next 12 months play out. That's a cautious read of the situation from a company with a lot of analysis and a lot of data about where their specific customers are. Now, there's also a supply side problem here that's adding pressure from a direction people aren't really focused on. When the new car market slows down, trade-ins slow down too. And trade-ins are one of the primary sources of used vehicle inventory for dealers across the market. If people are holding on to their current vehicles because they can't afford to upgrade, or because they're underwater on the loan and there's no clean path to trading it in, the cars that would normally flow through the used market aren't flowing. They're sitting in driveways. What that creates is a situation where auction prices remain stubbornly high even as consumer demand is weakening, because you have a lot of dealers all trying to source inventory from a smaller pool of available vehicles. Small dealers go to auction and there simply aren't enough good cars to satisfy what everyone needs. Prices stay elevated at the auction level. Dealers pay those elevated prices, bring the cars to their lots, and then discover that the consumer can't absorb the price they need to change to make a margin. So you end up with dealers caught between high acquisition costs and a consumer who is maxed out. CarMax is experiencing a large-scale version of exactly that problem, which is why they can lower prices and still not move the volume they need. They bought inventory at prices that assumed a consumer with more capacity than the consumer actually has right now. So what does this all add up to? CarMax's earnings are a data point, but what they're actually showing is a snapshot of a consumer at a specific moment. And that snapshot shows a buyer who is stretched enough that even the discount used car market is struggling to reach them. The buyers who would normally be at CarMax are either holding what they have or they've already been pushed down into the cash market at the bottom. The buyers who are at the bottom of the cash market are calling small dealers, asking about $500 down payments on $2,500 cars. And sitting above all of this is a loan market where Carvana is writing paper and moving it to connected entities and reporting profits that may or may not reflect what those loans actually produce over their full term. That's not a comfortable combination when you're looking at it from the outside. The thing that people keep missing about the car market right now is that a slowing CarMax and a seemingly thriving Carvana look like a story about disruption and innovation. One company figured out the model and one didn't. But when you look at what's actually driving those two stories, it's not really about which company has the better website or the more convenient purchase process. It's about the fact that one company makes money when cars sell, and one company makes money when loans get written and sold. And right now, writing loans and selling them quickly is more profitable than holding inventory and waiting for a consumer who has less and less capacity to buy. The question that eventually gets answered is what happens when a significant portion of those loans stop performing. And based on where delinquencies are right now, and based on what the consumer at the bottom of the market is telling us, when they call a small used car lot asking about financing a $2,500 car, that answer may be coming sooner than the market is currently pricing in. So practically, what should you take from this? If you're in the market for a used vehicle right now, the data from CarMax's situation actually works in your favor as a buyer, at least in the near term. They are motivated to move inventory. Their prices have been coming down, and they're going to keep looking for that right price point to get volume moving again, which means there's more negotiating room than there has been in a while at the larger used retailers. At the same time, their inventory quality problem at auction is real. The cars that are making it through the used lots right now are not always the strongest vehicles because the good ones are being held by their owners who aren't upgrading. So if you're buying used, the inspection and vehicle history piece matters more than it normally would. And if you're thinking about trading in or selling a vehicle you own outright right now, the private sale market is still reasonably strong because the shortage of quality inventory benefits sellers. A private sale through a platform like CarGurus or AutoTrader is going to net you more than a dealer trade-in in almost every scenario right now, and that gap is probably wider than it's been in a while. The broader picture here is that the car market is in the middle of a repricing process that isn't finished yet. CarMax's numbers are one visible data point in that process. The repo volumes, the delinquency rates, the customers calling small dealers with $500 looking for reliable transportation, those are others. And they're all pointing in the same direction. The market got significantly ahead of what the consumer can actually sustain. And the process of those two things finding each other is what we're watching play out right now. That's going to wrap it up for this one. If you found this useful, subscribe. We've got a lot more of this kind of breakdown coming. Until next time.